Hello, everyone. This is our 2024 Summer End State of the Union. And the theme is, so we survived, but how do we prosper in 2025? I'm joined by a very capable Chief of Staff, Eric Wong.
Hey everybody, nice to touch base with you again. At the time of this recording, I think we have 1 or 2 weeks left of summer, so we thought it'd be appropriate to connect with you again. So we have our State of the Union, and we're going to cover some big ticket items. So the first thing we're going to talk about is impactful multifamily trends. Next, we'll talk about capital calls and an interesting case study that pertains to us. And then finally, we'll round things off by talking about upcoming opportunities and then some tax savings and some profits that you might be interested in. So Omar, before we start this, usually I want to give you some shine. Why don't you tell our current investors and new people and people that aren't familiar with you, who you are, what we do, and why they should listen to you.
Great. So I'm the founder of Boardwalk Wealth. My background's in finance and investment banking. On the buy and sell side, when I was working in these places, I structured $3.75 billion of capital financing transactions at Boardwalk Wealth. We've done over $650 million in transactions across 3,400 units, all multifamily. Past sales, we've averaged 26.6% gross IRR and 2x equity multiple. Over to you, Eric.
Okay, well, thank you. That's a great time to transition to our first topic. First topic we'll talk about is impactful multifamily trends. There are a lot of things to cover here. So Omar, just a quick overview for you. We're going to review some of the stats that will affect rent growth, cost of construction, and demand. And then you'll talk about some of your thoughts and your reactions to some recent macroeconomic trends. And also tell us about this unique stat in multifamily starts.
Well, as you can see on the screen, this is just a sample for one of our markets. Multifamily starts have actually been declining after they went on a tear. The reason why they went on a tear is ZIRP era policies. ZIRP, is an acronym for zero interest rate policies. This meant that because real estate is a levered play, leveraged investment, when the cost of money is less, when interest rates are less, it is usually more lucrative and profitable to do developments. But that's when everybody else thinks it's lucrative and to do developments as well. So what we've seen is record supply hit all over the nation. I mean, we haven't seen this level of supply since the 70s and 80s hit in a couple of years. And what's happening as a result is there's a supply overhang, excess supply, even though we have very robust demand. And what's that's resulting in negative to sideways rent growth in a lot of market. But most importantly, what's happening is it's releasing some of that pressure that was coming after a decade plus of record rent increases. Now, that being said, the obvious next question I know, Eric, you're reaching to ask is?
Well, this is basically economics 101. Well, supply goes down. What happens with demand?
Well, in this case, supply is very high. Let me take it the other way. Supply has been very high, but demand has been very robust. So what's happening is, even though demand is at record highs, supply is exceeding that. That is putting downward pressure on rents. But now, when the Fed started raising rates, this is about 2 years ago, as a result of this, because there's a big lag. These projects sometimes take 2 to 3, 4 years to bear fruition, not our development projects, and we're going to get into that. This is why what happens is with the lag, what we're seeing, again, you can see on the screen, Sioux Falls construction starts as an example. Deliveries are next to zero, and then they're very low heading out into the future. Why? Because money costs something now. It doesn't cost 0%. So as a result, what's happening is pricing power is expected to come back to asset owners. Sometimes say mid-2025, heading into 2026 especially, because again, demand is at record highs. Not a lot of supply is hitting the market. And the supply that has hit the market in the last couple of months, that is quickly getting hoovered up.
Okay, so then you talked about what about demand, and how does demand affect the cost of construction?
Well, it's less what demand affects the cost of construction. It's a very complex subject, but essentially what we've been discussing, especially on our reserve style projects for the last 3 years, those sentiments are now being echoed. We see more and more in the mass media, as well as by other developers. Again, Reason for this is ZIRP era, zero interest rate era policies. If you see any of the buildings that are developed, is multifamily, especially in the last 5-10 years, you're going to see there's an amenity arms race. And this is primarily because when developers typically poll their residents, hey, what do you want? Everybody says they want the nicest, fanciest items. And it's a bit like what Henry Ford is reported to have said, that if I asked my customers what they wanted, they would have said faster horses. And the problem is, look, we all want nice stuff. I want nice stuff. I think most of the time Eric wants nice stuff. We all want nice stuff, but there's a difference between what we want and what we're willing to pay for. And our focus as a company has always been providing shelter at a price point that our residents are always willing to pay at. This allows us to have a resident, this allows us to have a customer, come rain or sunshine, with minimal revenue volatility. We are trying to dampen as much of the volatility as possible. So we view our development projects, especially, but all of our projects, as stores of value first. Why? Because we're managing our risk. This means that we are focused intensely on risk management from day one as our first priority. And this is in contrast to the average developers, excuse me, that is trying to artificially inflate short-term profits because they're looking to get in and get out of deals very quickly. That's not our business model. We want to be all seasoned investors, and our track record has proven that.
So let's move on from that and let's transition into interest rates. At the time of this recording, the market is pricing in some rate cuts. So Omar, your crystal ball, your CFA, please give us what your thoughts on this and how this is going to affect us.
Well, the Fed might be announcing a rate cut soon, hopefully. But the 5 and 10-year Treasury, as you can see on the screen, the market is effectively priced a rate cut because you can see the yields have gone down. When yields go down, this means the cost of money is less. Essentially, what's happening is the market is effectively priced this rate cut because they have looked at forward prices, anticipated the Fed's action, and this is why rates have already started going down, and we hope they continue to trend down. And to give you an idea, we have successfully initiated a refinance on Monarch Villas, beautiful asset in Sandy Springs, Atlanta, premier market of Atlanta, as well as qualifying for an extension on Pines and Lanier. So to give you an idea, in this declining interest rate environment, we have assets that are we are choosing to strategically take advantage of these declining interest rates and lock some of these rates at very advantageous terms.
Yeah, that's a perfect segue into rate and refinance issues. So why don't we move on to the next topic? The second topic we're going to talk about are capital calls. This is a very dicey topic. So why don't we just give people kind of the full scope of what's happening in our industry? So this is a very big issue for many investors in 2024. A lot of syndicators are having a lot of trouble. But we have never, Boardwalk Wealth, we have never done a capital call. So we've been able to do well on that front. Omar, just why don't you just give our investors and the viewers kind of a filter, though, of when capital calls are useful and when they're pertinent?
Look, first of all, nobody wants to have a capital call. Obviously, that goes without saying. But sometimes, depending on the asset, operator, business plan, market, there can be good reasons. But the underlying aspect that is underappreciated is that there needs to be an intrinsic value to the underlying asset. So, and any sort of dislocations that are causing this are temporary. Maybe there's an issue with the capital markets. Rates are too up, but the underlying asset is performing well. There is a temporary dislocation in the market, but the asset value long-term is not impaired. And some of the factors that I believe investors should look into this is, first of all, look at supply and demand. No matter what fancy math somebody does, I can build you the beautiful, nicest looking model in the world. At its very core, most of the investments we do are based on the fundamentals of supply and demand. So if this is a market with, say, dwindling supply, like a lot of the markets that we have are investing in, still great demand, then you know that there are fundamentals working in your favor. Now, obviously, you should look at historical numbers, have a conservative view ideally from third-party data on future numbers, supply and demand is always going to be 101. Then your sponsor needs to commit to a clear forward plan. What is it? Go-to-market plan with an emphasis of how the dollars will be used, what items they will be used on, and what is going to be the end result of these things, with timing especially being very important. And lastly, numbers need to be corroborated with third-party sources. So somebody's opinion on the future, it's nice, it's needed, but you need to have supporting evidence. It's trust, but verify.
Okay, so let's move from theory to practice, because we're talking about evidence here. So we have a case study, which is one of our properties in Orlando, Lofts at Eden. So Omar, why don't you set the stage about what's happening? So the comparison or the contrast between internal performance and having to refinance. So some of the things such as capital market influences that led to some of the options that we had to be faced with.
So first of all, as I mentioned, demand and supply metrics, and is the underlying asset value impaired? So Lofts at Eden is a great case study, not just in the asset and potential capital calls, which didn't happen, but also in the way we communicated and what are we telling you? Because at the end of the day, it's easy to give people advice, but you have to eat your own cooking. So let me set you the table and explain to you what happened. Lofts at Eden is a 2017 vintage, 175 unit, beautiful asset, built and situated in Sanford, Florida, which is a submarket, high growth submarket of Orlando. Great demographics, high median income. Here's the problem. Our initial term on the bridge loan, the first 3 years, was ending around July. We had 2 one-year terms. And while we were qualifying for those one-year terms, the lender still has to sign off on it. The lender was obviously throwing their weight around, trying to be hard to negotiate, but we had proactively given them a lot of notice. Excuse me. While we were working on our alternatives. So here what happened is we explained to our investors the pros and cons. The pros are great asset, great market, underlying value is not impaired. In fact, if you see on the screen, we've increased rental revenues by, I believe, 38% since we took over, other income by about 170-something% since we took over, and net operating income has increased by 71% since we took over. Now, here's the kicker. We presented all of the pros and cons, including what was and is our options on the takeout side. On the agency side, 5, 7, 10 years, as well as HUD and CMBS loans. And we showed basically that while each of these options requires a significant cash in refinance, like you have to put in money, hence a potential capital call, we found that in a declining interest rate environment, especially because of how good this asset is, it's a new vintage asset, continuing to push on revenue streams. We keep adding other income. We keep pushing on rent, while our occupancy is always around this 95-97% mark. So underlying value of the asset is very strong. This is a temporary dislocation. We told our investors, look, you have all these options, but we still think that it is better to extend, because when we extend, we buy ourselves some time. Rates potentially go down. We are in a more lucrative position heading into the future. And by the way, we always say you have to eat your own cooking. My partner Sam and I, we did eat our own cooking. We committed to our investors that before investors put a dime of their own money, our money, material amounts of our money, was going to go in to right size the deal. So Sam and I put in close to $800,000, if not more, of our own personal money into the transaction. We did not do a capital call, did not take money from outside, but in the interest of transparency, we had to explain and show all of these options to our investors. And as a result, we're lucky enough to extend the loan for 1 more year. We are continuing to have very high growth and occupancy. And by the time, from the day that we have actually extended the loan to today, rates have already gone down 50 to 70 basis points in certain cases, further providing validity to what our theory was and how did we put this into practice. But the big thing here is transparency. If you are not transparent, you do not provide a full plan with pros and cons to provide a full holistic picture to your investors, it doesn't work. And if you don't couple that with massive skin in the game, which Sam and I did, as I mentioned, we put in over close to $800,000, if not more, of our own money in, none of this stuff works. Transparency, clear planning, massive skin in the game. This helped us to avoid a capital call. But in the interest of all of this transparency, we did have to show everything to our investors, which we always strive to do.
Yeah, and I think we had a lot of feedback from that. one of the things that we really pride ourselves in is to be very available to the investors. So if you guys have any questions, always feel free to email Omar. I know he loves his inbox, and actually my inbox is filled up too, because we also, in addition to the webinar, we also sent out a survey. So we got feedback from the investors, and then we made a decision at the end, which was the best decision for investors going forward. So
I just like to mention that I'm very grateful to pretty much most of our investors that committed to putting more money into the deal. It's a good vote of confidence. We are very grateful for their respect, their understanding. But like we say, we have to eat our own cooking. We have to put our money where our mouth is, which is what we did.
Yeah, we actually did have quite a few investors who wanted to put additional money into the deal just to keep it moving forward, but having able to be put, that you guys putting your own money into it, that kind of put that option or that situation to rest for now. So let's talk about some positivity right now. Let's talk about the future, some opportunities. So we're going to segue into the next section. Omar, we have some questions from investors, and I'm going to fire them off to you right now. We have many questions about tax breaks as usual, but one of the things is, what do we have on the horizon? What can we leverage for property tax relief? And tell our viewers what are some of the opportunities that we have available in this niche thing called the Opportunity Zone Fund. So go ahead, please.
Yeah, look, so the obvious caveat always has been, don't let the tax tail wag the investment dog. And I always say that because people get really excited about depreciation benefits and don't realize that you should let the investment stand on its own 2 feet, and then all the tax write-offs are the icing on the cake and not the other way around. But look, we're always looking to get an edge, always looking to see how can we add more value to our investors. As an example, we just closed on Blue Stem Reserve in Yankton, South Dakota, by taking advantage of TID financing, which is basically a tax increment district financing. How did we do this? What does this mean? What we basically done is structured a deal by working with the municipality of Yankton, South Dakota, that desperately needed quality, affordable housing in their local city. And as a result, they gave us this sort of financing, which basically means property taxes are reimbursed back to us for the next 20 years. And by the way, this is assumable. So if we sell it to somebody else, they will also have this benefit. So this way, the value of the asset we sell will go up compared to peers. Now, the reason why I share this example is because you have to be creative and you have to understand how these municipalities, how the government works to structure a win-win situation. And we are more than aware of these things. We always keep our eyes on the ground. And this is why we're able to benefit. The fact that our reserve plan in Sioux Falls especially is very energy efficient, we have now enhanced that offering by also getting tax credits because we're building to a high level. Those tax credits, by the way, are given to investors in their prorated share on top of the depreciation write-offs.
Yeah, that we're able to do that for, I believe, Blue and Lorraine. We added that to the K1, so investors were able to take care of, or they were able to take that benefit. But that was the past. So Blue Stem, that was an offering that we closed on. What about the future? So what are some options for investors moving forward if they want some tax deductions for the current 2024 tax year?
So look, this is the interesting thing in developing in phases. What happens is the accelerated depreciation, especially for phase 2 and 3, comes in very quickly. Give you an example. When investors on Briarwood Reserve 2, we have some spots available for that. When they invest this year, because this is the offering is live this year, they get tax write-offs this year and next year. Why do they get it? Because phase 1 buildings have already been delivered this year. So that portion of their prorated tax write-offs, they are getting on top of tax credits. So in effect, investors will get it this year in phase 2 as well as next year. Now, phase 1 investors benefit because we got to sweeten the pot for them as well by getting additional bonus shares. So in some cases, they receive anywhere from 5 to 10% bonus shares on top of their investment. So investors in both phases benefit, and investors are able to get tax write-offs. Now, I just want to point out the difference between tax credits and depreciation write-offs, which in effect are tax write-offs. Tax credits are a one-to-one. This means if you have $100 of tax liability and we give you $100 of tax credits, your tax liability is wiped out. You owe the government $0. But if you have $100, in the case of depreciation write-offs, you have $100 of tax liability. You owe the government $100, and we give you, or any sponsor gives you, $100 in depreciation write-offs. Your liability doesn't go away because you've got to take $100 of your depreciation write-off, multiply that by your marginal tax rate. Let's assume it's 37%. This means you'll get $37 in effect as like the cash value. So you'll go 100 minus 37. Last time I checked, that math is about $63. So you will still owe the government $63. You've been able to reduce your taxes. You haven't been able to eliminate them. This is why tax credits are really lucrative, one-to-one. And that's why it's so important. Investors can target anywhere from 25 to 35% of their investment capital in the form of tax credits and depreciation write-offs coming to them for our reserve-style projects.
Yeah, I also want to touch on the Briarwood Phase 2, which you mentioned that we have a couple spots left in. And one of the things that really impresses me about Veltco is that we've been able to do all of these reserve developments on like pretty much on time. We're putting them online there. I mean, a lot of people say, "Oh, developments, there's risk, right?" But with this, when you're coming in Phase 2, like you said, not only do you get the tax credits and the benefits, but you get reduced risk because the concept works. Like there's already 5 buildings that are done, so now we're building the next ones. So that's kind of a very important point to highlight right there. The next thing we'll cover are 1031 exchanges. We get asked about this a lot. So investors that sell a property, they want a 1031 exchange into one of our offerings. Tell the investors what the benefit is and what we do for the investors and the service that we provide for them.
Look, we get asked this a lot. In fact, on most of our transactions, we have 1031 investors. Essentially, what happens is if you sell a real asset, usually real estate, for a profit, in the US tax code at least, you can, and there's certain stipulations. That's why one has to be very careful with the way they structure these. There's time limits and all. You can do a 1031 exchange. Effectively, this means is that any tax liability that you owe, capital gains or otherwise, that you owe as a result of profitably doing your last real estate transaction, which you just sold, you can roll those proceeds and profits into the next transaction tax-free. Essentially, you are deferring your taxes. What does this allow you to do? It allows you to, keep more money at play, 30, 40, 50, sometimes 70, 80% of your money, if not more, that is not taxed. It lets it compound for you at a faster clip. You get tax write-offs and all those associated benefits. And what happens as a result is you let your money work for you. As Einstein said, compound interest is the 8th wonder of the world. Let the 8th wonder of the world work for you. Now, we've done this on past transactions. We sold 2 transactions successfully. Investors made a lot of money. Equinox and Knight, Brighton Farms. Our investors elected, because it's still their choice, they elected to do 1031 into our projects. We have outside investors that sell their property or assets somewhere else. They're not affiliated with us, and they 1031 into our lucrative projects as well. But the issue, as I mentioned, is always timing. This is a government-created enterprise, so as you know, there's going to be a lot of paperwork. So we take care of everything, the legal process, all of this stuff. All of that is done in-house. You do not have to worry about it. You get the same benefits as everyone else. Very lucrative, but for many people, it is a great way to let their wealth generate and compound over long stretches of time.
Yeah, I wanted to actually highlight that point there in terms of investors 1031ing. It does seem from the outside that it could be an arduous process, but we have a lot of really good networks, and we've done this so many times. Investors coming into our deals after they sold the property, and then they 1031. So just basically all you have to do is you send me an email or you send Omar an email. Hey, I have a 1031 opportunity, and then we take care of it for you. On the next point here is that speaking of investments and new deals, Omar, what do we have on the horizon? Something they want to preview for investors, maybe?
So we still have a few spots left, as I mentioned, on Briarwood Reserve 2. Phase 1 has delivered like gangbusters. We delivered on time, number one. We delivered our last building, I believe, in July. We're already over 90% leased. So that is telling you how quickly we've leased up the units. So we've got a couple of spots there. We have an upcoming development, Jefferson Reserve Phase 2. Again, Phase 1 is delivering. This is the really cool part about Jefferson Reserve total, Phase 1 and 2, but Phase 2 specifically. It's in an opportunity zone, which allows investors to shelter even more gains than usual. We can go into the details. Reach out to me if you're interested. This is an even more lucrative play than usual. And following Jefferson Reserve, which we're going to launch in October, is going to be Fosfields Phase 1. That's going to be launched, I believe, in Q1 of the next year, 2025. Now, typically for our developments, we're targeting anywhere from the 16 to 25% net IRR to LPs, 3 to 4 year holding period. And with supply dwindling, as we showed earlier, deliveries have basically ground to a halt in Sioux Falls. We are now going to be delivering these units into a market where we as developers and owners have significant pricing power. That was not the case earlier.
Yeah, so speaking to Jefferson Reserve, we will be launching that probably sometime next month from this recording. But because we like you guys so much, if you have any questions, feel free to email me or Omar. We can give you more details. And that Opportunity Zone Fund is actually, it's a huge benefit. We can give you more details later on. But we've been asked about acquisition opportunities because we've only really offered developments this year, but we do have a special opportunities fund actually. So Omar, why don't you give us a little bit of info into that?
Look, so it's a great time. We recently announced via press release that we've done a big first portfolio acquisition in our special opportunities fund. I hadn't gone to public with this. Basically, here's the deal. We have all been theorizing, and it's true, that with all this spectacular rise in interest rates, a lot of mid-tier sponsors that either don't have good operational expertise or have good operational expertise, but they're just caught in a bad situation, or they have balance sheet issues, capital markets issues, they're going to be in trouble, and a lot of deals are in trouble. The issue is everyone's been talking about it. Nobody's really been able to affect any of these in big portfolios. We have been able to do this. How? Because I have great relationships with lenders. We've gone full cycle. People who've given us money in the past see the power of our platform. They see that there are secular tailwinds powering the multifamily sector, and with good, thoughtful operators that have deep operational expertise like ourselves, they want to back these people. This first portfolio, we've earmarked more portfolios in this fund. It's 679 units, approximately 72,000 unit workforce housing, very attractive entry cap rate of 6.9%, discount to last purchase price across the portfolio 16.2%. But most importantly, according to the recent appraisal, which is a couple of months ago, the discount is 35% plus. And the reason why we are able to acquire this is a few big name syndicators that a lot of people might know about on social media. They are in trouble, and we have been able to go and acquire their assets at below note value, by the way, in effect wiping off the equity of the last people. We didn't want to do it, but that's just the way these things are. And we have been able to attractively acquire this. Now, just to give you an idea, ever since these transactions have closed, and we're filling up equity for that, so if you're interested, please let me know, rates have already gone down 50 to 70 basis points. So already what was an attractive, lucrative acquisition in the middle of the summer has now become even more lucrative now as rates have gone down, and they're continuing to go down. We do feel that given the amount of carnage that's in the industry that everybody's trying to hide, more and more and more of these assets we are going to be able to buy at very attractive valuations. We are continuing to do that, but this is only possible if you have a team that has an operational and capital markets expertise and are not just heroes on social media.
Omar, you've always said that we're opportunistic investors, we're opportunistic multifamily syndicators. So you've got your wish. There's a lot of carnage out there, but I mean, we're going to take advantage of it so that our investors can prosper.
Well, my wish was not to have carnage. My wish was just to focus on our own internal abilities, be the best stewards of your capital, and be operationally intensive.
Okay, so with the Special Opportunities Fund and our opportunities that we're offering to investors coming up, it seems like summer does end with some hope on the horizon.
Look, we're not out of the woods yet. There are still a lot of pitfalls, lots of monsters lurking under the bed, but that also brings with it a lot of opportunities. Anyways, we do appreciate it. Thanks for watching. You can catch me on LinkedIn, Omar K1, on YouTube at Boardwalk Wealth, or you can always go to our website, boardwalkwealth.com.